So we've talked about fixed assets or tangible assets. We discussed what constitutes a fixed asset, talked about the cost of a fixed asset and how to record that, talked about subsequent expenditures of fixed assets, how to record that, whether it's an expense or part of the asset. We discussed three methods of depreciating fixed assets in order to match the cost with the revenue that's produced by the asset. And finally, we discussed the recognition or the accounting treatment for the disposal of a fixed asset. The last topic that we're going to talk about is intangible assets. And intangible assets is actually a very important area. If you think about the types of companies that are beginning to become the most valuable companies today, for instance, technology companies, software companies, social media companies, they don't have a lot of tangible assets. So if you think about Facebook, or you think about Microsoft or Google, those companies don't have a lot of buildings. They don't have a lot of heavy equipment. If you compare that, say, to oil companies, industrial companies of the past, steel companies, there's a huge difference in the types of assets that these companies have. And so a company like Facebook is not going to have the same types of assets as, say, Exxon. Exxon is going to have obviously oil drilling equipment, oil drilling rigs. It's going to have a lot of storage tanks, it's going to have pipelines, it's going to have refineries, very heavy industrial type of equipment, machinery, buildings, and certainly a lot of land dedicated to that. Whereas Facebook is going to have more, its assets, so to speak, are more technology, human, intellectual, capital type assets. So intangible assets is a very big component of the value of a company like Facebook or a company like Apple, a company like Microsoft, Google, but they're not the same as tangible assets. So when we're talking about intangible assets, what we're really talking about is a group of assets that can be broken down into different types of assets. First of all, we might think of some intangible assets as patents. Okay, so patents are the ability to produce a product under a certain idea or a certain formulation or a certain process, and have the ability to have the exclusive right to do so without competitors being able to use that same method. And you have that for a period of up to 20 years. So for instance, if you come up with a new formula for a drug, you're entitled to produce that drug using that formula, and no one else can copy that formula for a period of 20 years. So after 20 years, of course, then your competitors can go ahead and use that formula, and as you see with many drugs, that's when they become generic drugs as opposed to branded drugs. Copyrights, same. So here, I'm just going to put 20 years, but I think everybody kind of understands what a patent is. Copyright, same sort of idea that you have the exclusive right to a particular, say, artist's song or lyric or story or poem or something like that for a period of, I believe, 70 years after their death. So, for instance, you might own the rights to, say, Michael Jackson owned the rights to the Beatles library. And so he had the copyright, and he obviously paid some money for that, but he had the rights to sell and market those songs. And of course, if you're the author of a book or a song or a poem or an artist, then you obviously anything you produce would you would have the copyright to that. And then once you die, you could pass along that right to your heirs or to your family, or sell that copyright to someone, and they would have the exclusive right to market that for a period of time. Trademarks relate to the brands. So if you think about a trademark, you're thinking about, say, for instance, Coke, the name Coca-Cola, including the logo, the print, any jingle that goes with it, any slogan, all of that, the trade dress, all of that is part of the trademark Coke. So you can't develop a similar soft drink and make it look exactly like a Coca-Cola can, and with the colors and the print and everything else. Coke owns that trademark, and of course that's extremely valuable because of the recognition that brings to them. Nike would be another good example of that. The Swish logo, pretty much readily identifiable as Nike. That's tremendously valuable as a brand and as a trademark to Nike. Without the Nike brand, and certainly Coca-Cola without the Coca-Cola brand, Coke is really just a carbonated caramel flavored beverage. But when you add the Coke brand, it becomes a whole different product. So extremely valuable. Licenses would be another, and that would be for some type of limited period of time also. Trademarks generally would have really an unlimited life. I think the Coke brand, for instance, has been around for a long time, and I don't think they have any intention of discontinuing that brand. I think that's going to continue on for quite some time. So I don't think there's any question, if you were to think about the value of the brand to these companies, how important that is. And if we just take an example, for instance, of Apple, okay? So Apple, the value of Apple right now is about 1.2 trillion. So we'll put that in billions. And that would be the value right now. If you were to try to go out and buy Apple, buy up all the stock, and take control of the company just based on its current stock price, that's what it would cost you, 1.2 trillion. If we looked at just the physical assets, the fixed assets, tangible assets, tangible assets are somewhere, we'll call it 400 billion. So that leaves $800 billion of intangible value. And we're just going to assume, for purposes of this, that the tangible assets of 400 that are on their balance sheet is about equal to what their value is in the market. So that would then leave about $800 billion rather of intangible value. That's how much value Apple has in its brand name and in its intangible assets. Now the question is, and clearly that's the way the market perceives that, and I don't think there would be any argument that there's at least $800 billion of intangible value to that company. The question would be, how much of that 800 billion would be shown as intangible assets on the balance sheet? And maybe you could just stop the recording and think about what the answer to that might be. The answer is basically almost zero. And the reason for that is because if you think about how assets become assets, assets are only recorded, assets are recorded rather at cost. And so we don't automatically just have a piece of equipment. We have to go out and purchase the equipment. Or we don't automatically have supplies. We have to purchase the supplies. Or we have to sell something to have an account receivable. Right? So same thing with intangibles. They don't just arise out of nothing. We would have to go out and purchase them. So even though there is this tremendous value, Apple really started their own brand in the garage somewhere when they started the business. They never went out and purchased the brand name of Apple. So they never really purchased any of these brand trademarks or anything like that. They developed those all in-house, so they never really had to record an asset. They never purchased an asset. So how do we treat these assets? Okay, and again, we're only talking about assets that are purchased and are now recorded as assets on the books. For assets with definite lives, so we're talking patents, copyrights, licenses, we're going to amortize them. We're going to amortize those over their remaining useful life. So let's say we had a patent for $10 million. We purchased it for $10 million. It still has 10 years of life. Each year, we would record amortization expense of $1 million and credit patent for $1 million. So at the end of 10 years, the patent would be at 0, and we would have matched the cost of the patent, which is $10 million, with the revenue it produced over the 10 years of its useful life. Okay, so that's what we would do for patents, copyrights, licenses, intangible assets that have a useful or limited life. For indefinite life assets, where, for instance, trademarks, if we were to go out and purchase them, and usually when we go out and purchase trademarks, we usually call that goodwill. So for instance, up above, if we went out and purchased these intangible assets, if we purchased Apple, in this example, we would debit the tangible assets for 400. We'd credit cash for $1.2 trillion. And what we'd have is all the intangible assets. And if we couldn't identify them specifically, we would put them into a category called goodwill. Now, goodwill would be an asset on our balance sheet. It has an indefinite life because it really relates to trademarks and all the other intangibles associated with the business. As long as they don't fall within the patents, copyrights, licenses, if there are all the other types of intangibles that have indefinite lives, what we're going to do is we're just going to test that goodwill for impairment. So let's say in the above example, let's say $100 billion we determine of that goodwill no longer has value. We would make an entry something like this: loss on impairment of goodwill, 100 billion, and we'd credit goodwill of 100 billion. And we would make that adjustment, we would do that review rather at the end of every year, and we would make an adjustment if there was impairment. That doesn't usually happen very often, but it has happened in the past, and usually that's a pretty significant situation when you go out and purchase something and it's no longer worth what you purchased it for. So again, those are the two different methods that we would handle intangible assets: either amortize them or test for impairment.